And so I've reflected those closing entries in the T accounts, and now we can group all of those together into one journal entry, and I'll call that transaction C2. And we saw that there was wages expense of $1,400. There was utilities expense, $500. There was rent expense of $3,000. There was office supplies expense of $300 and depreciation expense of $1,500. So we can group those all together and have a corresponding debit to income summary for $6,700 that groups all of our expenses together. Now remember that income summary is actually a temporary account itself. And so what we need to do now is close out income summary to retained earnings. Income summary is just a snapshot of our income statement. All of our revenues will be credits in income summary. All of our expenses will be debits. So if we've made money, i.e. generated positive net income, there should be a credit balance in income summary. And in our case, if you net these two together, you can take a look at what's ultimately an income summary. And if we post the opposing expenses to our income summary T account, what we'll end up having is a remaining balance in income summary of $5,800, and that's our net income. And so what we need to do now is debit out that $5,800 that remains in income summary and have that be transferred to retained earnings in the amount of $5,800. And so what that's going to entail is a journal entry where we are debiting income summary to close that out for $5,800, and we're going to credit retained earnings for $5,800. And what we've done is transferred what we did generate net income of $5,800 to what we have in retained earnings on the balance sheet. And this reflects the fact that the owner's share of the firm is now worth $5,800 more. Finally, we need to close out dividends. Dividends are a return of capital to investors, and so what we had done in Chapter 3 was pay $1,700 worth of dividends to Flanders. So we're going to close out the dividend account through a credit to dividends, and the corresponding debit is going to be a debit to retained earnings. And so what we'll end up having is a debit to retained earnings for the $1,700, and we'll have a credit to dividends to close that out for $1,700 as well. And this makes sense because retained earnings are the profits that the owners have chosen to leave in the firm. So when they pay out a dividend, that money isn't in the firm anymore. Now, once we've produced our closing entries, we can actually produce an income statement and balance sheet. And so what I suggest you end up doing is to review them to make sure that you're comfortable with how I got to them. And so this is our income statement, highlighting our net income of $5,800. This is our balance sheet listing out all the things that we have or owe at the end of the accounting period. And then the last step ends up being posting a post-close trial balance to make sure that everything is ready for the next accounting period. So that's it. And so I suggest you review these financial statements to make sure that you're comfortable with the process that I went through to get to them. So that's it.